Hello, my friends. This is Paul Drockton, and as you know, I own Drockton Bullion. And the question of the day is why does silver cost more than spot price? It's a good question. Well, first of all, let me introduce myself. My name is Paul Drockton. I have my master's degree in history and economics. I've built numerous multi-million-dollar businesses, wrote over 2,000 articles and books. I was the host of the Drockton Financial Report, a radio program with over 1.2 million listeners, and I am the owner of Drockton Bullion. So, the first part of the question is what exactly is spot price? Well, let me explain it to you. First, silver is bought and sold on the COMEX, also known as the Commodities Exchange, right? Futures contracts are for 5,000 ounces of silver and are sold by silver producers, for example, silver mines. The length of the contract can be up to 90 days, and at the end of the contract, the buyer takes physical possession of the silver, usually delivering it in 1,000 ounce COMEX bars, like these right here. So, what we're talking about basically is we're talking about where supply meets demand. That's where price comes from. So the way it works is on the COMEX, right? The bid and ask average of all silver futures contracts at that moment in time, also known as the buy and sell, these are what's going to determine price or spot price. The more bids, offers to buy, in play, the higher the price. The more asks, which are offers to sell, in play, the lower the price. It's supply and demand. So the greater the demand, the higher the price. The greater the supply, the lower the price, right? So this is an example. So when you see spot price, you're always going to see the bid and the ask. And remember, basically, that this is based on what the supply is and what the demand is, right? Now, silver price fluctuates, but the contract price remains the same. So let's say I buy a contract today for $28 an ounce. That price will remain the same throughout the length of the contract. So between now and 90 days when it expires, that's the price. And what this does is this allows investors to speculate or to bet that the price of silver will go up, also known as going long, or that the price of silver will go down, which is going short. The speculator makes or loses money based on the spread between the current bid ask versus the contract price. So, if spot price goes up and I'm going along on a contract, I make money. If it goes down, I lose money. Now, the other side is there's short traders, which basically are betting that it's going to go down. And if it does, they make money. If it goes up, they lose money. Believe me when I tell you, the futures market has bankrupted many a man who thought they knew what the trend was. Now, instead of settling in silver, cash settlement is now permitted. What this means is that the silver seller can now settle with the buyer in cash and doesn't have to deliver any real silver. Unfortunately, this has resulted in mass production of paper silver contracts that make it appear that there is more silver available than actually exists. It's estimated that there are 250 ounces of paper silver for every 1 ounce of actual physical silver being traded. And what this means is that if the COMEX were to ban these cash settlements, the price per ounce of silver would climb up to 250 times its current ask price. And believe me when I tell you, this is going to continue to happen to some degree. I mean, we've already seen an 80% increase in the spot price from 12 months ago. Silver's gone up 80%. Now, in other words, silver price is being held down for the benefit of massive institutional investors like SLV, right? These ETFs are, as you can see, major holders of silver, and it really is to their benefit to drive the price down so they can get it for the lowest possible cost. And so they flood the market with paper silver. The banks flood the market with paper silver. And the result is mines are either halting or reducing production until spot prices goes up. So as you can see, right, mine production, right, continues to decline because mines aren't stupid. Their owners aren't stupid. They know silver's worth a lot more than what they're selling it for. So they'll sell enough to stay in business, but they're going to hold back on their reserves until spot price goes up. And this has created the shortage of actual physical silver. And this has forced premiums over spot to increase. For example, Silver Eagles right now, you won't be able to find a price less than $10 or $12 over spot. Why? Because that's how much premiums have gone up. So remember, the marketplace controls price. The banks control spot. And right now, there's a major, massive disconnect simply because what they've done is they've manufactured their own shortage by not permitting market price to adjust to where it really should be, which would be to everybody's benefit. Now, of course, the lowest premiums are available when you purchase from me, Drockton Bullion, right? And all you need to do, call or text 801-857-5529, or you can visit my website, drocktonbullion.com. This is Paul Drockton. God bless, and have a great day.